everyone, welcome to another episode of Intelligent Investing. I'm April Tan. The market remained weak last week, with the PSEi falling 2.9% to close at 5,759.37. Losers continued to dominate gainers at 178 versus 87, but the one bright spot was foreign investors turned net buyers, snapping a 5-week selling streak with 4.5 billion pesos in net inflows. Still, sentiment stayed bearish as earnings and economic data both came in softer than expected. On top of weak 3Q corporate earnings, which we'll break down later, the peso continued to weaken, closing at 59.06 pesos per dollar. Adding to the gloom, GDP growth slowed sharply to 4% in Q3, the weakest in over 4 years and down from 5.5% in the second quarter. While economists were already anticipating slower growth, the actual number was way below their forecast of 5.2 to 5.3%. Well, a large part of it was expected. We were anticipating already government spending growth to slow, and it did. And this was due to tightening of controls to control corruption, diba? The 26% drop in public construction. What really came as a surprise was the significant slowdown in consumer spending. That was really surprising. I think the last time we saw consumer spending drop to 4.1%, I mean, aside from the pandemic times, was 2010 or 2011. It was that long ago. So more than 10 years na natin hindi nakita consumer spending growth slowing to that level. And why did it slow down before? Well, you had the global financial crisis. And also, remember around that time, President Pinoy came into power and he had this platform, this anti-corruption platform as well. And when he first came into power, I think he was cleaning house and government spending growth also slowed initially. So we're seeing some sort of repeat of what happened when Pinoy first came into power. On the positive side, inflation stayed very low at 1.7% in October, slightly below expectations. With weak GDP and still soft inflation, it strengthens the case for another BSP rate cut in December. The BSP also sees inflation staying within the 2 to 4% target range over the next few years. The negative sentiment wasn't just local. In the US, the Nasdaq fell 3% and the S&P 500 dropped 1.6% as investors worried that the economy may be slowing faster than expected and that AI valuations are overstretched. Job cuts hit a 20-year high in October. Consumer sentiment also plunged near record lows due to concerns about inflation, layoffs, and the impact of the ongoing government shutdown. At the Global Financial Leaders Summit in Hong Kong, Wall Street executives like Goldman Sachs' David Solomon and Morgan Stanley's Ted Pick warned that equity valuations, especially in tech, are elevated. As such, stocks may be due for a 10 to 20% correction. Even Michael Burry of The Big Short revealed bearish bets against two popular AI stocks, Nvidia and Palantir, citing excessive market optimism. I guess the expensive valuations of AI have been talked about. If you think about this year, there's huge capex spending on AI, and it's being triggered by companies that are worried that they might be left behind. May pagka-FOMO yan eh, AI FOMO. So for example, Mark Zuckerberg was quoted as saying that I'd rather lose a few hundred billions rather than, be left behind. So essentially, that's what they're doing because AI is supposed to be the next big thing, The problem is a few cracks have been starting to show recently. For example, there was a study by MIT saying that companies that adopted AI have only seen minimal improvements in their productivity and profitability. And I think another group also did a similar study, and the improvements were also very minimal, less than 10%, and not everybody benefited from it. And aside from that, right now you're seeing a lot of circular type of investments, where, for example, Nvidia will buy shares in a company that will buy chips from Nvidia. OpenAI of ChatGPT also buying shares in other companies, and now it's entering into data centers, and then it's going to commit to buy chips from companies when in fact it's still losing money. And recently, of course, we know the story about it trying to get government guarantees. So, there are some questionable things going on. And by the way, remember earlier this year, China revealed DeepSeek. It showed how China was able to develop a ChatGPT type of application for much less. Jensen Huang even said that China is only like a nanosecond behind the US. So, you have all these things coming out. And then AI stocks are just so expensive. Yeah, profits are still there. But, it kind of raises questions about how long this thing would last. Third quarter corporate results have been underwhelming so far. From the 23 COL-covered companies that have reported, 12 missed expectations, while only 6 beat them. Median profit growth was unimpressive at just 3.1%, highlighting the impact of slower economic growth on profitability. Let's break it down by sector. The banking sector delivered stable but unexciting results this quarter. Median profit growth was 4.8% year-on-year. On the positive side, loan growth held up at around 13%, while most banks expanded their net interest margins by 10 to 40 basis points despite fear of margin compression from lower rates. Thanks to a favorable asset mix and lower funding costs, higher loans and margins helped net interest income to grow by about 15% year-on-year. However, provisions were higher this quarter as most banks normalized credit costs from last year's low levels. Overall, banks remain resilient, but earnings momentum is soft. Consumer names had a rough quarter. Median earnings growth was just 4.7% year-on-year. The common story is margin pressure as prices of key inputs like coffee, cocoa, coconut oil, palm oil, and packaging materials stayed high, dragging profitability lower. On the telco side, both Globe and Converge reported weaker than expected results. Globe's core income fell 15.3% year-on-year to 5 billion pesos, as flattish mobile revenues and a slight increase in home broadband revenues were not enough to offset higher depreciation and interest costs that ate into profits. Interestingly, GCash parent Mint's contribution to Globe's earnings rose 10% year-on-year to 1.5 billion pesos. However, it was down 27% quarter-on-quarter. We suspect that the drop reflects the impact of the e-wallet gaming restrictions. Meanwhile, Converge posted a modest 1.2% profit growth to 3 billion pesos, missing expectations. Quarterly net subscriber additions slowed, especially in the higher-paying postpaid segment, pulling down revenue growth to only 7.4%, while costs and manpower expenses grew faster. This led to an 80 basis point drop in EBITDA margin to 60.3%. One of the few standouts this season was ICTSI. Its net income surged 26% year-on-year to $268 million, well above expectations. This was driven by a 12.4% increase in port throughput and a 6.4% rise in yields per TEU. Revenues were up worldwide from the Americas to Asia and EMEA. They also expect contributions from its Durban terminal in South Africa set to finish in 2026. Margins also improved with EBITDA climbing 1.9 percentage points to 65% as operating costs grew slower than revenues. Simply put, ICTSI remains one of the few consistent outperformance in this earnings season. Next, for the gaming sector, Plus reported a steep 51% drop in 3Q profits to 1.7 billion pesos, badly missing expectations. Revenues were flat year-on-year at 19.1 billion pesos, but fell 23% quarter-on-quarter as the mandated delinking of e-wallets from gaming platforms took effect last August. Still, there's no sign of structural demand loss. Plus is also expanding its offline payment network through a new partnership with Buy and Center, which should help recover revenues in the coming quarters. The share price of Plus, interestingly, last week went up by 20%. Even though the earnings were bad, right? But, I think that's not really fundamentally driven. One of the shareholders, which owns around 3%, was reclassified to a public shareholder. So now it will be accounted for as free float. If your free float is higher, it means that your weighting in indices such as the PSEi index will be higher. Therefore, fund managers will be buying more shares of Plus just to make sure that they aren't too underweight if ever they are. For this week, investors will keep an eye on more third quarter earnings results, especially from property and consumer names led by restaurants and retailers. In the US, we have inflation data, which could influence the Fed's December decision. However, there's a possibility that the BLS won't be able to release the October number due to the ongoing government shutdown. And finally, we have tech stocks performance to see if last Friday's rebound can sustain momentum. As far as the implementing tighter controls on, let's say, the DPWH projects and other things, temporarily, again, it would lead to a slowdown in economic growth. But if the spending is actually done well to things that would have longer term positive impact, then that should be more beneficial rather than them spending and spending over and over for things that do not really have long-term improvements. I mean, at least now you know that they'll be spending where it matters, and hopefully that spending that they do will have a positive longer-term impact on economic growth. That's it for this week. Weak GDP growth, disappointing earnings, and global uncertainty are still weighing on sentiment. Hopefully, growing prospects of lower rates and cheap valuations will convince investors to go bargain hunting. If you found this useful, don't forget to like, subscribe, and share this video so you're first to know what's moving the market. Once again, I'm April Tan. Stay sharp, stay selective, and as always, invest intelligently.